Hello, everyone, and welcome to our final Just Alpha weekly market recap of 2025. I'm your host, and as we wrap up the trading day for Friday, December 19th, we aren't just looking back at the last 5 days. We're closing the book on a truly historic year for investors. This past week saw the S&P 500 inch down by less than 0.1%, while the Nasdaq 100 managed a modest gain of just over 0.5%. In contrast, the Dow Jones Industrial Average experienced a more significant decline of nearly 1%, and the Russell 2000 fell by about 1.25%. The U.S. dollar index rose by roughly 0.33%, reflecting a defensive stance among investors as the 10-year Treasury yield dropped by 4 basis points, indicating continued demand for safer assets. Oil prices remained relatively stable, up just a tiny fraction, while gold enjoyed a slight uptick of nearly 1%, hinting at some safe haven buying as market sentiment fluctuated. Diving deeper into market movements, the week was characterized by a complex interplay of factors influencing performance. The overall advance-to-decline ratio across all stocks improved slightly to 1.16, with over 63% of stocks above their 200-day moving averages, suggesting a mixed breadth of participation. Notably, the mega-cap stocks showed a strong advance-to-decline ratio of 2.25, indicating that large tech names were supporting the market. However, this was contrasted by the small-cap stocks, which weakened significantly with a ratio of just 0.53, reflecting a divergence in market leadership. The options market also played a critical role this week. As volatility remained elevated, particularly in tech stocks, dealer positioning was pivotal. Many market makers were found short gamma, which led to forced selling during periods of market decline. This dynamic often exacerbates price movements, as dealers need to hedge their positions, resulting in a feedback loop that can amplify volatility. Some of the market's intraday swings were attributed to adjustments in delta hedging strategies, especially as traders navigated around key strike prices and the option expiration week. As put-heavy structures weighed on the index, the lack of liquidity reinforced these movements, leading to sharper declines on lighter trading volumes. Sector performance reflected this broader market tension. While technology stocks showed resilience with an advance-to-decline ratio of 2.65, healthcare also fared well with a ratio of over 3-to-1, indicating strong participation in those sectors. However, sectors like consumer defensive and utilities faced increased headwinds, suggesting a risk-off sentiment among investors. The financial services sector exhibited mixed participation, even as the sector remains heavily scrutinized in light of ongoing regulatory discussions and interest rate implications. Turning to macroeconomic influences, recent headlines have focused on both positive and negative narratives. The White House economists' prediction of massive refund checks has some investors optimistic about consumer spending, which could provide a seasonal boost. In contrast, a stock trader's insights suggesting an 8 to 10% chance of a stock market crash in 2026 have added a layer of caution, particularly as we head into the year-end. With the Santa Claus rally on many investors' minds, the question remains whether the enthusiasm can translate into sustained strength, especially as breadth trends suggest mixed signals. As we look at cross-asset themes, the bond market's response to equities has been telling. The decline in Treasury yields reflects a flight to safety, which is often characteristic of a market grappling with uncertainty. Gold's slight rally indicates a renewed interest in safe haven assets, while the dollar's strength reinforces a defensive posture among investors. Meanwhile, oil's stability suggests that energy markets are somewhat insulated from the immediate volatility seen in equities, yet they remain sensitive to broader economic signals. But before we look to next week, let's take a moment to look at the full year. 2025 will be remembered as the year artificial intelligence transformed from a trend into a massive economic engine. As of today, the S&P 500 is finishing the year up roughly 16.5%, while the Nasdaq has surged over 20%. It was also a landmark year for gold, which soared to record highs as a global safe haven. Looking ahead to the coming week, the key question will be whether the current breadth can confirm this leadership in sectors like technology and healthcare, or if we will see a reversion as earnings season approaches. Will investors continue to favor large caps and growth stories, or will the pressure on small caps lead to a broader market correction? With the holiday season upon us, market dynamics could shift quickly, so keeping an eye on participation metrics and sentiment will be crucial. On behalf of the entire team here at Just Alpha, I want to thank you for trusting us to navigate these markets with you all year long. We wish you a wonderful holiday season, a restful break, and a very prosperous new year. We will see you in 2026.